Done. Some technical difficulties, so I'm just going to put Simon on to start the presentation.
Good morning, everybody. I'm Simon Wicks. I'm the CEO of Butler Rose. Thanks for joining the presentation this morning. There's myself, and we've got a couple of speakers from Streets that are going to be talking to you this morning. First of all, I'm going to give you a bit of an overview of how the recruitment market's changed over the last 12 months. Obviously, it's been unprecedented time, really, which is a term that's banded around quite a lot. But it's certainly been a very interesting year, and we've seen a lot of changes in the recruitment market. So I'm just need to get my slides up. Right, okay, sorry for the technical issue there. Hopefully you can see my slides as well as me now. So yeah, I'm the CEO of Butler Rose. We've had a difficult year, I think it's fair to say, but we've really bounced back over the last 12 months from where we were. So I've been in recruitment now for nearly 24 years, working in the accountancy and finance recruitment market, and it's fair to say that I haven't seen anything in that 24 years as challenging and strange as the last year. So I'm just going to take you through the next slide. I thought what I'd start off with doing is give you a bit of an overview of my business and what happened to that over the next 12 months. So you can see that last March, I've modelled it through in terms of our GP through to this March, and I've modelled it against 100% of the GP that we did in March last year. Now, we actually had a record month in March. Things were going really well. So I set up Butler Rose at that point in 6 years. We had our best ever month in terms of fees. Our headcount was at its strongest ever. And it's been a really good year, and we topped it off with a fantastic end to the year. And then you can see what the effects of COVID did. So at one point we were down to about 30% of our GP just sort of 3 months into the first lockdown. As you can imagine, the temporary market kind of crashed. We had lots of temps out who were just finished because the employers were furloughing their own people on a permanent basis, and therefore didn't see the need to have temps in there. We lost about 2/3 of our temps within a 2 or 3 month period. And we also just had a real drop off in job flow in terms of permanent recruitment. Obviously, some sectors were still recruiting, areas like FMCG, so some aspects of manufacturing, food manufacturing particularly, were going gangbusters, but a lot of businesses just stopped recruiting because the economy had stopped. So yeah, around kind of June, July time, I had my head in my hands thinking, God, what's happened to my business? I think things were looking quite bleak. We'd furloughed a lot of our own people. But actually, when the first lockdown ended, things started picking up again. And you can see actually this March just gone, we've just finished our next year end, and we're actually back up to almost 100% of the GP that we did last March. It was our second best ever month in 7 years. So it's that real V shape that he talks about in terms of the economy and recruitment. We really saw the effects of that. So I suppose there's some common perceptions now, if I dare use the term normal, but in a normal recession, this is kind of what happens. So supply of candidates outstrips demand. And in this case, obviously, we've had lots of people being furloughed, quite a lot of redundancies, a lot of businesses in many sectors having recruitment freezes in place and just not recruiting anybody at all for some time. So the perception is there's got to be a lot of good finance candidates to choose from. So if you are recruiting, there must be lots of people that have been made redundant, for instance, looking for new jobs, not happy where they are, and that the competition therefore must be lower because there's less jobs out there and more candidates. So candidates are going to bite your hand off for a job. So it's a fair perception, like I say, in I suppose a normal recession, but really that's just not been the case this time. It's been a very strange year. And I'll come on to some of the reasons for that in a minute, but those kind of typical perceptions of it should be relatively easy to prove if you are, just don't hold true. So what's the reality? So there are less finance candidates coming actively to the market, and a lot less, particularly the higher caliber. This is very much a generalisation, so no offence to anyone that's been maybe done, but on the whole, it's a generalisation. Companies don't always let their best people go if they're making redundancies. So sometimes the candidates that come into market due to redundancies are always the highest caliber. Obviously, that's not always the case. But there are a lot less candidates coming to market just generally because a lot of them are working from home. There's been a real change in their working pattern over the last year. They just haven't got time to focus on another job. There's been a lot of issues around obviously homeschooling and childcare, maybe having elderly relatives that have isolated, they've already shopping for, little things like that. That just means that a lot of people just haven't had the time to look for a new role over the last year. And then obviously on top of that, there's very much a nervousness around moving at the moment because of COVID, because they worry that they've got quite a flexible working pattern at the moment. Are they going to get that in a new role? What if that company goes through a downturn and there is a kind of last in first out situation and they lose any redundancy benefits they might have in their current employer by moving roles? So lots of reasons for candidates just to be very nervous about moving or just not having the time to. On top of that, when we are getting candidates through to accepting to having offers from new employers, in a lot of cases they're turning them down, and I've really never seen anything like it in 24 years. The amount of offers that we're actually getting turned down now is unprecedented. And again, there's a few reasons around that, but I think very often candidates are dipping the toe in the water, and when push comes to shove, again, that whole nervousness about moving kicks in, and they're talking themselves out of roles. And on top of that, there's a lot more counter offers happening as well. So candidate will hand the notice in with their current employer, get a counter offer, and they decide to stay. And again, that's more than I've ever seen before. And I think that's partly related to the fact that a lot of companies are wanting to hang on to their people because they're worried about recruiting replacement in the current climate. They're also worried about inducting people. With a lot of people working from home, they just see it's been quite a challenge, maybe getting people embedded into a company properly and then inducting them in when they're doing it remotely. So we're seeing a lot more counter offers being made, and a lot of candidates there deciding, again, related to that nervousness, to accept the counter offer and stay where they are. So it's been a very challenging time for new candidates, despite what you might think. So what can you do? So we've done a lot of consultancy with clients over the last year, particularly the last few months, around what they can do to actually secure candidates for their roles. So if you are recruiting into your finance team, here's a few tips about what you can do to get the right people on board. So the first thing is at the outset reaching a wider audience. So well-written adverts, always important, but probably more so at the moment. That's your kind of shop window to attracting people in the first place. So whether you're advertising directly or you're advertising through a recruiter, just make sure the adverts are well written, that you're really talking about the benefits of joining the business, about the career opportunities, and going all out to make that role look as attractive as possible to get the applications in the first place from quite a short candidate pool. The other thing is to make sure you're tapping into that what we call a passive candidate pool. So with less people actively looking, you need to be going out there and finding these people. Now, a good recruiter will help you do that, because a good recruiter should be well networked, have a lot of contacts they can go and approach. But we're finding that a lot of our placements now are coming from headhunting, from approaching our networks and finding people that way, rather than people just responding to adverts. One of the benefits of remote working, which obviously every company now is working to some degree, is that you can consider whether you can tap into a wider pool. And we've actually got quite a lot of clients that have benefited from saying, well, actually, this role doesn't need to have somebody coming into the office. We can look anywhere. So we've got clients that are now recruiting nationally or even internationally to find the right talent for their roles, because the role can be home-based and remote. So again, something to consider if you're finding talent in your local area. It's hard to come by. And then when you get through to the interview stage, the term I use is interviewing to secure the candidates. There's a few things you can do around that. So preparation is key. We've done a lot of work over the years with preparing candidates for an interview, and as recruiters, that tends to be where our focus is. We prepare our candidates and make sure that they know everything about the role and the opportunity and the kind of buttons they need to press when they go for the interview. But we're now doing a lot more work with clients and helping them to prepare, because it really has turned on its head, and you need to be really selling the opportunity to our candidates. So to prepare, we still get candidates going in for interviews where they come out saying, well, actually, it didn't feel like the recruiter had even read my CV before I went in for the interview. So just make sure you're at least reading the CV, looking at the candidate's background. If you're using a recruitment consultant, speaking to them about what buttons you need to press. And then in the interview itself, find out what the candidate's looking for in terms of their career aspirations, in terms of the support they need, so that when you come to talking about the role and the opportunity, you can really, I suppose, sell back to them. You have to effectively do a bit of a sales job and really tell them why your company is the best company for them to come and work for, why the opportunity is great, security is really important, why they're going to have a long-term future with you. So all those things are really important at the moment. And then I say challenge, but be nice. So it's kind of treading that fine line. I think the days of the Alan Sugar-esque interviews have long gone. So you need to make a candidate feel warm and fuzzy almost, about you and about the business. If you're interviewing them, you want them to think, well, actually, I want to work with this person, I want to work for this company. But you still need to challenge. Candidates will sometimes turn down an offer if they don't feel they've been challenged enough through the process, because they maybe think the employer is almost too desperate to recruit. So still give them some challenging questions, but do it in a nice non-sugar-esque way, I would say, and take them on a concise journey, as I call it. I'd always recommend not offering a candidate after a first interview. We do see it, and there will be times when you need to. It might be because you're in a rush to recruit, or that candidate's in demand, so you need to move quickly. But the problem with that is that very often a candidate will come out of a first interview with lots of questions themselves they still want to ask, and the second interview is the opportunity for them to do that. So we are finding that candidates, again, because of that nervousness in the market at the moment, if they don't feel they've got enough information to accept an offer after a first interview, they'll turn it down. So I'd always recommend doing a two-stage process if you've got time to, and taking candidates on a bit of a journey, introducing them to other people in the business. Bear in mind as well that a lot of interviews are still being done remotely. You want to kind of get that engagement and get them get a good feel for the business, which they might not do from one interview, just meeting one person on a video call. So I'd recommend all of those actions are taken when you're interviewing. And then the last point is making successful offers. So again, as I said earlier, we get a lot of offers turned down at the moment. So a few things you can do, again, whether you're using a recruiter or you're offering them directly and speaking directly, just kind of reiterate why you're offering them the role. A bit of flattery honestly never goes amiss. So tell them why you like them for the role, what you think their skill sets are, what the other people that interviewed them thought of them, and again, get them feeling valued, because that can be a big part of their positive mentality, I suppose, in terms of accepting an offer. And make a fair offer. And this happens all the time in recruitment, but we'll take a role on where our client's saying, well, we'll pay, for instance, 50 to 55,000. The candidate's made it clear from the outset that they're looking for 50,000, and then the company will come in and make an offer of, say, 47,000. Very often with the view that they'll increase if they need to. But again, with candidates quite nervous at the moment, that can really put them off. And it's quite hard to come back from that sometimes. If you've made them feel a bit undervalued by not making a fair offer, even if you then increase the offer to what they're looking for, it's kind of put you on the back foot a bit. So I'd always urge you to consider what you're being told by the candidate or by the recruiter in terms of the salary, and then come in at the outset with a fair offer to secure them. And then the last point on this slide is that use an experienced consultative recruiter. Now, I'm not going to do a big sell on Butler Rose, but that's what my business is full of. We've got lots of experienced consultative recruiters. And I think, again, that's really important in the market at the moment, because, like I say, you need someone that's going to go and tap into those passive candidate pools, approach people from their networks, headhunt to find you that talent in the first place, and then hopefully use their negotiation skills to kind of guide the candidate through the process and you through the process, and make sure that when an offer is made, that they're helping you to secure that candidate. I'm just going to touch briefly on flexible and home working. So I've mentioned this before, but this is probably the biggest change that we've seen in the market in terms of candidate expectations over the last year. And it's the one that really is, I think, here to stay. So we're now easing out of lockdowns, things returning to normal, job flows picking up, a few more candidates are coming to market. So things are gradually starting to get back to normal. But I think the biggest impact of COVID is around home working. It's now the biggest reason that candidates will turn down an offer. It used to be, things around the salary or the role, but it's very often now the home life balance, the option to work flexibly, because people have got used to it. People are used to being able to log off at 5 o'clock and they're at home, or take the dog for a walk at lunchtime, or spend some time with the kids. So it's become really high on the agenda for candidates. So I think the difficulty as a recruiter, very often what we're finding is that somebody's with their current employer and that employer is saying to them on an informal basis, look, you don't need to come back into the office full time in the future. You can still work from home a couple of days a week. That's fine. But when they're coming to look at a new role, they're wanting that flexibility written into a contract. Now, if you don't have that in your contract for existing employees, that can create a bit of a parity issue, because we're getting clients saying, well, I can't formally tell this candidate they can work from home 2 days a week, for instance, because we haven't got that in the contracts for our existing employees. The one thing I could do is urge you to look at that, speak to your HR team and look at whether you should be putting that in as a benefit for your existing employees, which will help with retention. And new people coming into the business, because at the moment that is really going to help you to attract people if you can look at that as a benefit. So we've done a lot of work with clients around this. If you want to speak to me, it's all about that issue there, then feel free to. So that's it for me. I've gone through that at some pace. So we've got some guides here that I've got on this slide that we've put together around some of these topics, which go into a lot more detail than I've kind of whizzed through this morning. So if you do want to have a chat with me, or if you've got a local Butler Rose consultant with them, and we can send you these guides, or we'll talk you through it and give you any more information, then we're happy to. I think there'll be an opportunity at the end of this session for you to ask me some questions. But thank you for your time, and I'm now going to hand you over to Alan Endersby from Streets. Thank you.
Morning, everybody, and thank you for joining us this morning, and thanks to Simon for that really interesting. It's kind of got my brain going and thought-provoking, some of the things he was covering and different ways of thinking at it. Quite often I think we sit there making decisions and only look at it from our side, whereas I thought Simon's presentation was really good at thinking the side of the candidate and of the employer and covering both, which was fantastic. My presentation today is going to be about practical implications of a COVID-19 year-end and audit changes as a result of Brexit and our withdrawal from the EU. I'm a accounts and audit partner at Streets. I've been in the accounting industry since leaving school, so over 20 years now. And some of the changes that are coming up are unprecedented, and there is certain elements of what I'll be going through where even talking to institutes, there aren't definitive answers about. So there's a lot of common sense being applied in what we're talking about, but hopefully I'll be covering a few areas that will actually just make you think about things and give you things to talk about to your accountants or your individuals at Streets if you're already Streets clients. So starting with the practical implications of a COVID-19 year-end and an audit thereon, we're going to cover kind of 3 main areas with one overriding thing. So if we're going to look at Companies House filing extensions, government funding and assistance, and going concern. And whilst talking about them, we're going to consider the reporting within the financial statements for all of those areas. First area we're going to look at then is Companies House filing extensions. So you may or may not be aware that Companies House has been automatically applying a 3-month extension to the filing date of their accounts. Now that ceased on the 5th of April 2021. So what that effectively meant that if you had a year end of April 20, you had 12 months, your filing date would have been April 21, and for May 20 would have been May 21, and June 20 would be June 21. However, once we get to the 31st of June 20 year ends, they revert back to the 9-month filing date. So we need to make sure that they're all filed by the end of April this year. So we have to just be careful and not get too comfortable with that. There is still the availability of getting that 3-month extension. However, it will no longer be automatically applied. It has to be applied for through the Companies House website. There is one technical point to do with only one filing extension being permissible in an accounting period, and it can't take it more than 12 months after the end of that accounting period. One other thing to really remember that we found with certain clients is that this is a Companies House extension, not a HMRC extension. So therefore tax liabilities are still due effectively 9 months and a day after your tax after your year end has passed. So remember that it doesn't affect when the tax is actually due. So we want to make sure that we don't rely on that extension in any way. Other potential implications of the filing extension is to do with group companies. If you do happen to be part of a group, you'll want to make sure that your filing dates for parent subsidiaries do align. Reason being that if certain exemptions are taken, we need to make sure that parent company accounts are filed alongside the subsidiary accounts. So if you decide to take an extension in one entity and not in the other, it can cause issues at Companies House. And the other thing is banking and contractual covenants. You need to be really careful of what the wording of your covenants are. We've seen examples of where the covenants are saying that the accounts must be submitted on time, and after that it refers to 9 months after the accounting year end, not 12 months. So just because you have taken the extension, you need to make sure that there isn't other things affected as a result of that. Looking now at government funding and assistance, I'm sure you're all familiar with the Coronavirus Job Retention Scheme, or otherwise known as the furlough scheme. Quite often it's referred to. The key thing to note here is it is a government grant. The income should be recognised once reasonable assurance that the conditions have been met that the grant will be awarded. So what that means in accounting terms and presentation of financial statements, we would recognise it on an accruals model. So we effectively want to match the income to the costs. So example being that if you had a December year end and your December furlough claim wasn't done until, say, the 14th of January, you would want to be bringing in that income as a debtor so that it matched against the costs. One crucial point as well is that the income is shown separately on the face of the P&L as other income. It's not netted off against the cost. Now, this has a few implications that you might just want to consider. So if you normally in your accounts don't show anything under other income, and all of your turnover sits on the turnover line in your profit and loss account, it's going to be relatively obvious to readers of the accounts that your other income relates to Coronavirus Job Retention Scheme income. I mean, that is available to public site anyway through the website, but it just brings it to people's attention. But what you might want to be aware of is that part of making use of the Coronavirus Job Retention Scheme was to do with the fact that the business was struggling with it during COVID. Now, if when you do a year-end set of accounts that your turnover looks consistent with last year and your profits have increased, but you still have other income and Coronavirus Job Retention Scheme income, you just want to be careful about what that may show to the readers. And a very interested reader is likely to be HMRC. So again, this is one of the bits that's completely unprecedented. So we have no idea exactly how HMRC are going to police these sorts of things, but there is a thought out there that HMRC could look at sets of accounts and just consider the correlation of what the turnover is showing, what the profit is showing, and the amount of Coronavirus Job Retention Scheme income that's been received. It's just something to consider. At the end of the day, it's historical. You've claimed it now. There's not a lot you can do about it, but it is something to just think about. And the other change to the financial statements as a result of this is recognizing grant income will require an additional accounting policy to be disclosed within your accounts. And I'm sure your accountants will be able to help you with that accordingly. Other types of government funding and assistance has been the Coronavirus Business Interruptions Loans, otherwise known as CBILS, and the Bounce Back Loans. The crucial thing to note is that in the majority of these loans, you have what's quite often referred to, and we hear being mentioned, an interest-free period for the first 12 months. where no repayments are made. Now, technically speaking, it is not an interest-free period. The loan is accruing the interest, but the government is paying the interest on your behalf. And that can be the same for arrangement fees as well. So similar to the way that the furlough scheme works, the fact that the government is paying this element on behalf of the company to the bankers for the loan, it should be recognised as grant income. And therefore, we're hearing some mixed reports from banks and, well, in fact, mixed reports from clients about banks as to whether the loan statements being provided are detailing out the exact amount of interest that the government is covering on their behalf. Where statements do show that, it will be quite straightforward to calculate exactly the amount of interest that's been paid by the government, and therefore it will be a simple accounting transaction to just bring in the government grant income. However, if that isn't separately disclosed, it is possible that a net present value calculation might be required in order to show that. I will add, just in case anybody does file using FRS 105, the accounting treatment is slightly different, where there is no grant income recognised up front, and the amount of interest paid over the full term of the loan is effectively recalculated on a straight line basis. Other funding, COVID-19 funding, could be rates relief. Unlike the previous two items, with rates relief, this is a pure reduction in expense relating to the period in which the benefit has been received. So there's no government grant income to reflect here. What you might want to consider from an accounts and audit point of view is to making sure that you have documentation of exactly which period your rates relief covered, so that it can be accounted for accordingly. These things are always quite straightforward if it all fits within the same accounting period. It tends to be where they span two accounting periods that things get slightly trickier. Small business grants that have been received from local authorities, again, these are recognised immediately. You would need to check your grant wording, but from what we've seen, at least 95% of the grant wordings we've reviewed all state that the grant is compensation for loss of income or additional expenditure already incurred as a result of COVID-19. So because it's effectively relating to a past expense or lost income in the past, is recognised immediately. And a rent holiday, it's a better term for it would actually be a rent concession. So it's effectively where, due to COVID-19, you have been given a rent-free period. This is not where you've been given a holiday and you're effectively not paid anything for 6 months and it's all been moved to the following 6 months. This is where you're no longer having to pay rent for that period. And in these instances, similar to the rates relief, the reduction in cost is recognised when the benefit occurs and it's not spread over the full term of the lease. Going concern. So I'm sure the majority of you understand the concept of a going concern. So effectively, at the end of the year, as accountants and yourselves as directors need to make sure that your business is a going concern, and this assessment needs to take place when the accounts are approved, not from the year end. So we would be looking to make sure that you have all of the right information in place to effectively allow us to establish a decision around going concern. One thing that I always point out to clients as well is it is the director's responsibility to satisfy themselves that going concern is appropriate. 95% of the time, going concern will always be appropriate unless you are already aware that your entity is intending to liquidate and that there's no realistic alternative to that. However, there is additional work around that as a result of audits. One of the main, some of the main indicators that there could be going concern issues are decreases in turnover, trading losses in the year, having your balance sheet a net current liability or a net liability situation. There may be loss of key staff without replacement, key customers, or you may have borrowings that are reaching maturity that there is no realistic prospect of renewing or repayment. So when we see these sorts of things, particularly when it comes to auditing, this is going to be a flag that additional work is going to be required in the going concern area. So what can you do to effectively preempt this and make sure that you know that you are a going concern and you're comfortable to make that statement? Budgets and cash flows are the first thing, and I'm sure you are already looking after these sorts of documents and are doing it. But one thing that we, and I think lots of people can improve on, is actually carrying out sensitivity analysis and flexing their budgets to see exactly where it is. And the new buzzword that the ICAW seem to be using is stress testing both their budgets and cash flows, and that means that you are aware of where the breaking point is. So if turnover hasn't recovered yet, you know, how long can you go at the levels you're at to the point when actually you're going to run out of money, and that you have that information. I'm sure you're having management minutes discussing these sorts of things, management meetings discussing these sorts of things going forward. One of the key points we don't always see is that these are minuted. I think it's a really good idea that if these meetings are minuted so that you have that evidence to show the going concerns being fully considered and that you're covering yourselves going forward. And the other option with it is group support, where finances have been a struggle and you've relied on group support. Obtaining a letter of support from your parent company can be a really good way to just gain extra comfort around going concern. So now I'm just going to finish off my presentation talking about Brexit and reflections on the implications for financial reporting. So the impact of Brexit is going to vary massively from business to business, but some of the challenges you may have been seeing are challenges with supply chain, and it might not even be directly supplying to you. It might be your usual supplier in the UK that's having an impact on their supply chain. So it's just a matter of knowing exactly where that situation, where the issue is. There are regulatory matters. You know, labour mobility, so you know, if employees being able to work in other countries may have been affected, and customs and duty tariffs. All these can all have an impact and should be being considered by businesses that are trading and using the EU. The key place where, in a set of financial statements where you have your chance to discuss Brexit and effectively reassure the readers of the accounts, is within your strategic report. So under UK law, all companies, apart from small companies, are required to complete a strategic report. The strategic report has a particular format that needs to be followed, but when it comes to talking about Brexit, I would strongly recommend that you effectively set out the risks and uncertainties relating to Brexit and this new situation from the 1st of January 2021, once we've left the EU, what impact that's had on the year's accounts that you're talking about, and then what trends and factors are likely to affect the future. So effectively, what you're doing is a three-stage approach. First approach is setting out what the issues are. Second stage is what's happened, so what the impact of that is so far, and then the third stage, what the impact is likely to be in the future. And this is your chance to effectively set that out for the readers of the accounts. In terms of actually the numbers within the accounts, there are certain areas where Brexit could have an impact. Inventories are quite a large one, so stock. There might be Brexit may directly affect attributable costs such as customs, tariffs, and even just the value of inventories in having to import it. So you need to consider that you're valuing your inventories correctly, whether you're using average cost method or LIFO or FIFO, and just thinking about the impact that may have on your accounts. Foreign exchange gains and losses. So the situation we're going in at the moment is likely to bring more exchange rate volatility. So therefore, you may need to consider the need for forward contracts or hedging in exchange rates and those sorts of things, and just the general impact that may have on your accounts. Deferred tax assets. So if in the past you recognise a deferred tax asset for example, tax losses that are going to be recovered in the future, you just need to consider, will those losses be recovered in an applicable period as soon as they would have normally been before us leaving the EU, and what the likely impact of that may be. And the other one is the measurement of non-financial assets and financial instruments. So effectively, the fair value considerations of exactly what these assets are worth may well be impacted as a result of the Brexit, and it may increase the need for impairment reviews to be carried out. So that's something to just consider there. Having touched on going concern with the COVID-19 side, it follows suit that Brexit relates to very much the same sentiments that was said there, that effectively where we need to be comfortable. There is a new auditing standard that we should make you aware of that does require a bit more comprehensive and structured auditor risk assessments of going concern. So those companies that may be audited may see some additional work being carried out around this area. Then we have some company law changes as a result of us leaving the EU. So for accounting periods starting on the 1st of January 2021, we may find that small companies, well, in the past, small companies have been eligible for a number of accounting and audit exemptions. And in the past, there has been an exception to this rule where the small company is part of an ineligible group. The definition of an ineligible group is where they are a subsidiary, so there's a parent company that is traded on a regulated market in an EEA state. From 1st of January 2021, the legislation changes, and that now the ineligible groups will be where the companies whose shares are traded in the UK rather than in an EEA state. This means that where they were previously in an ineligible group, they may now qualify for small companies exemption. So that's the sort of thing that would be good to raise with your accountant if you feel that may be applicable to you. Exemptions from preparing group audit accounts and intermediate parents. So a UK intermediate company is exempt from preparing group accounts where it and its subsidiaries are consolidated in the accounts of an EEA parent company. From January 21, the EEA parent company changed to a UK parent company. So from the 1st of January 21, where you are a non-small parent company in the UK that was taking advantage of the exemption, you may find that it's no longer available. There is one caveat on that this would be where the EEA parent prepares its accounts in its local GAAP. If it is using international standards, it will be fine to carry on in that basis. It wouldn't be applicable. And the final bits are to do with dormant companies and accounting reference dates. Effectively, these are to do with where parental guarantees are provided from companies within EE states to avoid having to prepare dormant accounts or to gain exemption from audit. If you provide a parent guarantee, this now needs to be provided from a parent within the UK rather than within the EU. These are quite technical changes, and everyone's situation is going to be very different. So if one of these things that I've mentioned you feel may be applicable to you, I'd recommend that you just touch on it with your auditor and they'll confirm the situation accordingly. And that concludes my slides for today, and so thank you for listening. I appreciate it's quite a dry subject with quite a lot of information, but hopefully it will have at least flagged a few areas for you. And I'm going to hand over to Luke to talk about tax.
Thank you very much, Alan. Just very quickly, is my microphone working? If it isn't, just please let me know in the chat box. What we're going to... thanks, Mike. Alan's obviously talked about some of the accounting impacts, company law impacts in regards to the COVID-19 pandemic, and how there are some unprecedented issues we have to deal with from an accounting aspect. What I'm going to talk about now is some corporation tax planning following the budget 2021, and ultimately what the government intends to do to pay for the billions and billions that it's been having to inject into the economy to get us through the pandemic. So firstly, what we're going to talk about is obviously the probably the headline mechanism to claw back is the increase to corporation tax. The cynic in me thinks it is from April 2023, so that is just under 2 years' time. The cynic in me thinks that just before an election, if the economy recovers well, it does give the Chancellor time to play with this and probably not increase it quite up to 25%, which would be a political decision. But as it stands, the rate from April 2023 will go up to 25% for profits over £250,000. Now I'm going to discuss in a couple of slides time what we mean by profits over £250,000, as that equally could, as we have to look at groups and what we call associated companies, as that profit limit does need to be split down. However, if your profits are below £50,000 from April 2019, so majority of larger businesses this won't apply to, but the smaller businesses are protected and they will continue to pay at 19%. But then there is this tapered rate that sits between 50,000 and 250,000, where you will pay a taper of from 19 up to 25%. But as I'll discuss on the next slide, actually you will be paying slightly more than the headline rate of 25% because of how marginal relief works. So it's the calculation that enables to take the corporation tax rate from 19 to 25% when your profits are within that bracket. The marginal rate is 26.5%, and I will discuss how that works. So, slightly small, but I thought I'd put a summary of the corporation tax rates we've had since April 2000. Interestingly, on the 1st of April 2000, the standard rate of corporation tax was 30% and the small profit rate was 20%. So some would argue having a small profit rate of 19% and a standard rate of 25% is still better than what we had 20 years ago. However, if you look, the small profit threshold, so the threshold where you where you started tapering up from the lower rate, back then was 300,000. Now it's only 50,000. And also bearing in mind the 300,000 profit rate was based on profits in April 2000. We'll have nearly 23 years of inflation since then. So that 300,000 potentially should be a lot higher. So what that means is, while the headline rates are lower than they were what will be 23 years ago when these rules come in, actually in real terms, cash tax terms, is these rates of tax will be a lot higher than what we have seen in this with this slide over 20 years. So how does it work? So how does marginal relief work? How do we calculate our tax with our tax band? So we've got two ways of doing it. So option one, if we have profits of 200,000, what we would do is we would tax them so 200,000, sorry, is above the 50,000 threshold. So we would tax them at the full rate, 25%, which gives us 50,000. And then we apply what's called a marginal relief calculation to that. Of which you'll see the calculation there. That gives us a relief of £750. So effectively the tax due, so the marginal rate due is 24.62%, so 49,250. There is an easier way of doing that for single companies, and that's very simply what we do is we take the 200,000, so option two, The first 50,000 we would tax at 19%, and then the balance 150,000 we tax at 26.5%. So it's slightly higher than the 25%, which we'll come to in a minute. Why are we paying tax at a slightly higher rate than the headline rate of 25%? So 150,000 at 26.5% is 39,950, which gives us same answer, 49,250, an overall effective rate of 24.62%. Now, why do we have this slightly higher marginal rate? Well, very simply, we have to even out the transition from the 19% to the 25%, and to enable us to even out that transition, we need to pay tax at a slightly higher rate on the bit in the middle. So what planning do we have? Well, what we need to make sure we do is, where we are looking at tax relief, is if you are, say, you've got profits of £75,000, say for the year ended 31st of March 2025, by reducing your profits down from 75,000 to 50,000, say for example, types of expenditure, capital expenditure, your effective rate of relief is actually 26.5%. So it's then worth considering measures to reduce your profit. Also, when we look at profit recognition as well. Now, as we mentioned before, the bands, so the £50,000 limit and the, if we just scroll back, the 50,000 lower limit and the £250,000 limit is applicable to a singleton company. But what if we have got other companies? So whether we're a group or we are, say for me, example, I have shares, I own 100% shares in company A and company B. How do we apply the tax rates? Well, what we have to do is we have to apportion these rates, so these lower limits and upper limits, by the associated companies within our group or companies under our control. Now, what is an associated company? Well, an associated company is at a particular time, within the last 12 months, one company has control of another, or both companies are under the same control of the same person or group of persons, and it also includes their associates. So when we're looking at a company, say I control, so I control my company, I have to actually think about my members of my family and what companies they control, and whether potentially these companies are associated for the purposes of the profit limits. Now, associates of a person, it also includes your spouse, it includes blood relatives, and also when we look at some trust arrangements, it includes beneficiaries that are associated with settlers of trusts. Very rare. However, there is a get out when we look at family members of whether these two companies are of substantial commercial independence. So if they're reliant on each other, and we'll go through that in a moment, then they are associated. But if they are completely separate, not relying on each other at all, we can not make these companies associated for the purposes of these tests. Now, here's just the example. So a group company, we have a holding company with a trading company that sits below. Both companies receive income. Holding company owns the property. They would be associated for the purpose of these tests. So the 250,000 limit is divided by 2 to 125 each. And also the lower limit is divided to 25 each. Shareholder controls trade company 1, trade company 2. Again, because they're under the control of the same person, the limits are also divided. Now, what if, again, going back to what I said earlier, what about if we have Mr. Bloggs, who has 100% of A Limited, and Mr. Bloggs' son, who has 100% of B Limited? Well, they are associated with each other, they're father and son. So we go back to the test together with my associates. Who do I control? Well, Mr. A, together with his son, controls A, and Mr. A, together with his son, controls B for these tests. So they would be associated companies because they are controlled by the same persons and their associates. However, what we need to look at, and we've not had to look at these tests since April 2015 is we need to look at how A and B operate together. So has Mr. Bloggs' company A made a loan under uncommercial terms to company B to help Mr. Bloggs' son start his business? Are there personal guarantees given by Mr. Bloggs for his son? Do they do the same thing? Do they have common customers? Are they the same type of business? Do they share employees, premises, equipment? We need to understand all of these between company A and company B to understand whether they each get their own £250,000 and £50,000 limits, or we have to divide those limits between both of them. Typically, what we see this is mainly with husband and wife or civil partner companies, where the example always given by HMRC is two companies. One company is a pub, and the second company is maybe providing the services of the restaurant. It may be that the husband or one spouse owns the shares in the pub, or one spouse owns the shares in the restaurant's business, but effectively 99% of the time, because of all of these tests, they would be deemed to be associated for these purposes. Secondly, one of the other measures introduced from the budget to generate to encourage companies to invest in the economy, it was introduction of the super deduction and temporary first-year allowances, and these run from the 1st of April 2021 to the 31st of March 2023. Now, what these are designed to do is, going back to the corporation tax rate, 2023 will be 25%. The problem the government could foresee is companies would wait until April 2023 to incur capital expenditure, because they will get relief at 25%, and in certain examples they'll get relief at 26.25%. So therefore companies would delay their capital expenditure programs. That's not what the government wants to achieve. The government wants companies to invest now. So these rules are designed to get you that relief now. Now, they're only available to companies, so partnerships and unincorporated businesses do not obtain the relief. The super deduction only applies to plant and machinery, and the 50% first-year allowances only apply to special rate items, of which we will go through in a minute. They only apply to new assets, so not second-hand assets, but demonstrator machinery is fine, as long as it's demonstrator machinery only. Now, I say demonstrator machinery because it doesn't apply to cars, assets acquired from connected persons, gifts, or in the year your business ceases. Now, there is some anti-avoidance. So if the super deduction or the first-year allowances are only available if you've committed to incur the expenditure on the 3rd of April, after the 3rd of March 2021, and that includes just ordering it. So what you can't do is, if you ordered a piece of machinery on the 28th of February 2021 and you thought, these new rules have come in, and you cancel that order and then you reorder it on the exact same terms, to get around this rule, HMRC have got some anti-avoidance legislation to stop you doing that. So it needs to be ordered on or after the 3rd of March 2021. Now, in addition to this, structural buildings allowances and the annual investment allowance, which has been recently extended to £1 million to the end of this year, are still available, and in regards to integral features and where the AIA won't apply, also won't give you any added benefit, it is still added benefit in other circumstances. So, quick one on leased assets. So super deduction doesn't apply to what we call leased assets. Now, HMRC haven't released their manuals on this as yet, but based on what we understood the rules were to be for first-year allowances, and again, they might have to make some tweaks to this, is leasing. So holding company leases plant and machinery to a subsidiary company. That is a leasing arrangement no, you can't do that. So companies need to think about how they purchase their machinery to take advantage of the super deduction. Now, short-term accommodation, so trades, hotels, care homes, serviced offices, retail, possibly. We do need further clarification, but these are trades. So we believe that, yes, you still can obtain a super deduction. Commercial tenants, no. So it is a commercial letting, then no, it isn't, but it is an area of clarification that is needed, and we're still waiting for government guidance. How does it work? Well, it's 130% relief for expenditure. And there are periods, so we need to look about the straddling period, April 2021, and when it ceases to end as at April 2023. There are rules around that. So, for example, if you buy something now and dispose of it in a year's time, then you'll have to pay the 130% back. But if you dispose of it in, say, 5 years' time, when these rules have ceased, then you don't need to pay the 30% back. But there are slight issues over the periods entered into and afterwards. So just a quick example. So production line purchase in 2022 for £3.5 million. Well, the tax relief, because of the super deduction, means it is worth £864,500 in tax. Without the super deduction, it would have only been worth £275,500. So it's a real cash saving there by making the investment now of £589,000, and that is what the government have set to achieve by introducing these rules. Special rate assets. So these are assets that are not plant and machinery. So hot and cold water systems, heating systems, lifts, electrical systems within a building. Usually they are part of the building in law. Currently it's 6% writing down allowance. So you spend 100,000 without the AIA, you get 6%. So 6,000 in your first year. This has been increased to 50%. So this is a real tax saving again for businesses that are looking to incur expense or build trading premises within the next couple of years. The AIA is still available on this, so we can knock off the £1 million of this, and anything above that, you'll get a first year allowance at 50%. So the AIA in this effect becomes worth £2 million because of how it works. So again, it's definitely worth considering. And just a quick, what do we mean by embedded allowance within buildings? So buildings, you won't think this, but they're genuinely, it's full of plant and machinery and integral features. Now, if, for example, if you build a high-tech office for £1 million, yes, it's got bricks and roofs, floors, windows, and generally won't qualify for plant and machinery allowances. They will qualify for structural buildings allowances, but there's lots of plant in there. And what we need to do, and what I tend to do, is I'll go in and I'll survey these buildings to make sure we're eking out as much of the tax relief as possible out of these buildings to effectively give you real cash terms in savings. So if you look at offices, I've done a list here of potentially how much of the cost of the construction of that would qualify for tax reliefs. So warehouses, small offices, with a small office, generally they're very low in plant and machinery, so 10 to 20%. But when you look at care homes, for example, you're touching around 50%, car showrooms 40%, holiday parks 50%, and specialist structures you can get up to 90%, such as cold and chilled stores. So again, it's when you're looking at constructing an office building or something along them lines, then it's definitely worth considering. And again, speak to us early doors, because we can really assist you here with getting the best bang for your buck. And then lastly, I want to quickly talk about the temporary extension of the loss carryback rules. So like we did with the global recession back in 2008 onwards, generally companies and partnerships can own, sole traders can only carry back their losses back 12 months. However, the government has reintroduced rules basically allowing you to carry losses back, not just up to the prior year, but to what we call PY2, so the second year and also 3. So you can carry back trading losses back 3 years. Now, it is subject to a cap for companies and unincorporated businesses of £2 million for each tax year. And for company claims, if you haven't yet filed your accounts or tax return, then HMRC will allow you up to, there is a 200,000 de minimis on the loss to effectively file a loss carryback claim and obtain a repayment of tax without filing the return. But that will only be available once the finance bill has received royal assent. So generally that's designed to help a lot of very small businesses to effectively obtain tax repayments for losses carried back early. But again, you can carry back to the prior year. There's already rules there that says you can claim back, you can carry back a loss without filing the tax return as long as you have good management information. We can file a claim back to HMRC before the tax return is filed to get you that repayment sooner. There's no £2 million cap on that into the prior year, but we do need to make sure there is good management information to be able to supply to HMRC to quantify the amount of loss to carry back. Thank you very much, and I'll hand back to James.
Hello, everyone. I didn't have an opportunity to introduce myself at the beginning. So my name's Doug Greer. I'm a divisional manager for Butler Rose, covering the Northern Home Counties. So yeah, I just wanted to take the opportunity to close off today's event. Firstly, I'd like to thank obviously Simon, Alan and Luke for their expert guidance. I hope that was of interest to you all. And from myself, if you have any recruitment needs, or equally if you have any consultancy advice that you would like to echo what Simon mentioned about some of the additional services that we can offer around handling counter offers, market mapping, etc., then I'll be more than happy to offer my advice. We'll be following up today's event with the presentations and obviously a link to the recorded interview. So no, thanks very much for your time. If there's any questions, please feel free to add them into the chat, where our presenters from today will be able to answer those. So again, thanks very much for your attendance, and yeah, we hope to speak to you all soon. Thank you.